In this video, I want to talk to you about the difference between active versus passive income. Now, I recently just had a gentleman step into this lab who was a multifamily investor who praised about passively investing. And it's one of those topics where, he defined it very well, actually, because he said there's a very big difference between giving someone your money and having them just run, the play essentially. And then you don't have to worry about anything, right? Not even vacancy, etc. You just give them money, you sit back, then you wait a couple years and you get a return. Now, that is truly passive income, but it has its numbers and you get passive numbers. Now, if you have bulk, right? Like a bulk load of money, right? And you're going to do it and you're going to focus on continuing to grow that bag, I personally think does make sense. Now, if you have a little bit of capital that you're trying to leverage, I think there are some plays that you could run on the single family side that could get you returns much faster. Now, when you think about that, when you think about speed, when you think about money, when you think about wealth is based on the speed amount of time that it takes to make that money. So the reason it's important to talk about this topic is because that's like saying, is $1 million a lot? Well, it depends. Was $1 million made in 25 years? Because that's about 40K a year times 25 years gets you $1 million. But if I make $1 million a year, it's in less time, right? 1 year to make $1 million versus sometimes a month versus a day. What's the difference? The amount is the same, 1 million, but the time is different. And so the way I look at it, and the way one should look at it, is what is my goal? Because my goal is to make a certain amount of money and it's not to be a passive investor. Well, then there's some levers you can pull. Now, the lever that we like to pull is, what if there was a high profit, high return on investment, but there was a lower amount of effort required? That's what we pull when we talk about the midterm insurance space. It's a smaller lever that we can pull on, right? Or I should say it's a big lever that we can pull on where it's not as high maintenance as Airbnb, but it does have a lever where you can pull where not high maintenance, low, and high returns. Now, it is certainly not passive, definitely not passive, but big lever, right? This not passive either. Again, high maintenance and still high returns. So if you think about that, you can definitely implement one of your choice. We like low maintenance or lower maintenance, higher returns. And then of course, passive, if you want to be completely passive, get yourself a multifamily, and of course, low maintenance and I would say decent returns, right? Because it's all relative. Compared to these, it's going to be a little bit lower. But if you have a lot of bulk in capital to put to work, it's all relative because then you have a higher return on the capital put in. In short, if you put in $1 million and then your money doubles in 4 years and you get back to $2 million, well, then I would say if it's a higher leverage and you have more capital to put, then you do this. But if you have a lower and you want to have a higher leverage, lower amount of money in, higher leverage out, then you can do this. Because again, why do we say multifamily? You have $1 million, buying a dozen homes at $1 million is more, again, labor. Or buying, let's say you go to Indianapolis and you get yourself 30 homes. Don't kill me, but I know that there's low margins there, or at least lower amounts. This is what we need to talk about when we think about what strategy should I do. And there's a fundamental difference between having, again, low leverage, high maintenance. And that's the fundamental difference between, again, below this line is active, above is passive. Now, this can be used as a stepping stone. A lot of investors have used this as a stepping stone to get to a point where they have a bulk where they say, you know what, I don't want to run this anymore. But the reason why we like the midterm rental insurance route is because you can still do this and have a job. You can still do this and run your business, because once you get a tenant in there for 3 months, 6 months, 9 months, it is certainly lower maintenance, lower turnovers, lower management of cleaners, but still just as high of the returns, or even sometimes higher, depending on what you can negotiate with these insurance companies. And so this is a sweet spot and perhaps even a stepping stone to this, But however, one thing that is very important, very critical for this conversation and why we actually love the space even more, if you're currently getting value from watching this video, you'll want to make sure you take a second and click below to grab the midterm rental insurance blueprint to help accelerate your process in being able to land these midterm rental insurance contracts with respect to your marketplace. Make sure you click the button below and grab it and continue on with the gems in this video. There is another lever here that's not being talked about in this diagram, right? And that lever is the fact that when you work with these insurance companies, you now officially will have two assets. Within this, you have a list of relocation specialists. And if you know anything about lists in business, those are sellable assets. So here you have Airbnb. You don't necessarily get a list of your customers. Now, there might be tools like StayFi that allow you to extract the email address, which is powerful, especially if you're in the vacation rental market, but most people stay at places once. If you're in a place where you're in the vacation rental market, power to you, they'll keep coming back, great. If not, though, this is a one and done, right? It's like one and done, one night stands, right? Now here, we're talking about, it's not a one and done relationship, because I have a relationship with a relocation specialist and their relocation agencies that will continue to come back to me and keep me occupied. This is a very, very big caveat, because I have now a list in a relationship list that even could be a sellable asset. I could even sell the list, just like a book of business, just like I could also sell the asset. So now you get a 2-for-1 deal, right? So I actually have a bigger lever doing this game, because now it also gives me the confidence to know that, hey, if I have a great list and great relationships in these specific markets, I can continue to buy and increase or at least decrease my risk, because I will have higher occupancy and higher profitability. Again, none of this is passive. This is building an active business now, where you have two assets. You have the properties and you have your list, your book of business that continues to grow and becomes a lever of its own that keeps you high profitable, high margins, higher margin than this, especially over time. And again, lower maintenance, still maintenance, but lower maintenance. Here, high maintenance, high profits. Don't like the fact that you don't have control of your list. Most markets are one and done. Rarely do people have repeat business. We have had some in Airbnb, but it's certainly not as high as a repeat of doing business with a relocation specialist and or even the company. When they look at you in their database, they're like, we've done a lot of business with them. Now you have established relationship. Again, multifamily, again, passive, low maintenance, again, margins relatively lower compared to what you can make. Again, with all things considered, we didn't even throw in the cost segregation that you can do, the forced depreciation, the short-term rental loophole where you don't have to be a professional, a real estate professional if you actually have more hours spent than your entire team. Again, I'm not your accountant, but there are certainly loopholes and advantages to being an active participant investor in the short-term rental hybrid model, right? Because you would have to do a hybrid. You would do short-term rentals with a combination of a midterm rental strategy. But I like the fact there's a lot of levers to pull for a lot of individuals. And here, rather than just giving 50K and letting it wait 4 to 5 years to double and still getting some cash flow on there, I like this game because I can have a very separate case study where I can show you we've grossed just as much of that in 1 year, right? By putting in way less and generating way more. And yes, some will say it's an active and definitely not a passive business, but it has a high and a very long lever that we continue to pull time and time again. The question is, which lever will you pull? If you got value from this video, make sure you check out my how to turn your properties into profits with midterm rental insurance video.